Yeah, hi. Good evening to all those who joined our call. I hope all of you and your friends and family are safe and healthy. FY20 has ended on a rather unpredictable note where we have left contending with a human adversity that has traversed the globe. The COVID-19 outbreak has been especially harsh on certain sections of the society who have been worst affected in this crisis, either due to unemployment loss or unavailability of daily necessities. Marico has partners with various government organizations and have been able to provide meals for migrant laborers, the police force, health workers, and the disadvantaged during this time. We are also able to distribute safety and hygiene kits to primary healthcare workers, police force, emergency service staff, and later to our Suraksha stores. We are committed to help our community to alleviate the hardships posed by this crisis. I would start with a quick brief for the year and the quarter gone by and the future outlook before I leave the house open for questions. With COVID-19 turning into a pandemic, each of our markets have been impacted and local governments have responded with varying degrees of stringency to combat the crisis. In India, while the macroeconomic situation prior to the COVID outbreak was particularly challenging, the disruptions leading to and during the national lockdown over the last fortnight of March brought it to a near standstill. Bangladesh and Southeast Asia were relatively less impacted due to restricted lockdowns imposed on the last few days of the quarter. On the other hand, MENA and South Africa, where macros have been uninspiring, witnessed considerable impact. In this context, the company ended with a flattish top line in FY20 with an underlying volume growth of 2%. Domestic volume growth was 1% and international constant currency growth was 5%. Benign input cost environment in key markets led to 200 basis points improvement in operating margins during the year. As a result, EBITDA grew 11% to INR 1469 crores and PAT excluding one-offs grew 13% to INR 1043 crores. In FY20, free operating cash flows stood at INR 1040 crore, up 10% year-on-year, which is testament to the financial discipline we have been able to exhibit in an otherwise subdued and volatile environment. Now coming to a quarter gone by, in India, we started on a positive note and was trending better in Jan and Feb as compared to the previous two quarters. However, the early signs of improvement across categories seen until early March was more than offset by disruptions in the second half of March, due to restricted movements in some states culminating into a national lockdown in the last week. In this context, it is also pertinent to note that we could mainly bill some quantity of Saffola edible oil and foods in the last 7 days of the quarter, especially in modern trade and some urban outlets. As a result, we ended with a 3% decline in primary volume terms. We drew encouragement from the fact that secondaries grew in low single digits during the quarter, and had COVID not happened, we were on course to deliver mid-single digit volume growth in primary terms. There has been a reduction in inventory at both distributor and retailers as of March end. We continued to experience healthy offtake growth and market share gains across 90 to 95% of our portfolio. As regards to the 110 basis points drop in A&P, it is mostly due to the NPD spend in the base in the previous year in India last quarter. As you know, we had launched Creme Oil and True Roots. Post spend were more or less at similar levels of last year till March 15th, when we withdrew advertising only in the last week of March. There was no significant reduction in A&P in international. Let me delve into the India business. Parachute had a decent start to the quarter with a low single-digit growth in the first 2 months after the pricing intervention got implemented from the beginning of the quarter. However, due to much reduced sales leading to the lockdown period and the near cessation of sales in the last week, it declined by 8% in primary terms. Our offtakes grew healthily and it gained market share of 250 basis points in the last quarter, which is manifestation of the strong brand equity. Secondary growth for the full year stood in mid-single digits. In the current environment, Parachute is well placed to accelerate the conversion from loose oils and mop up shares from marginal players who will be both under pressure both from working capital constraints and access to distribution. We remain focused on providing a more aggressive value proposition on the recruitment packs, especially when consumers are going to have lower disposable income in the coming quarters. During these times, consumers will prefer trusted brands, especially which are manufactured under world-class hygiene standards, untouched by hand. In VAHO, we are experiencing better trends, flattish to mildly positive growth in the first 2 months as compared to the previous 2 quarters. However, with consumption trends in the premium segment of hair oils continuing to be a dampener, coupled with zero sales in the last 7 to 8 days, VAHO declined 11% in primary terms. However, secondaries declined in low single digits. We continue to do relatively better in the bottom of pyramid segment as Nihar Shanti Amla consolidated market share position with 90 basis points increase in volume share. As consumers are likely to be more value-seeking post-COVID, we'll have a stronger play at the bottom of pyramid and the core segment to drive volume growth and garner market share. Having said that, we will continue to have a 3-pronged strategy on VAHO over the medium term, gaining market share in the premium segment led by aloe vera and dry fruit oil, where we have seen healthy traction at the top end, especially in modern trade and e-com, drive value in the mid-segment packs and aggressive participation in the BOP packs. Saffola continued its healthy run from the previous quarter and delivered a stellar 25% on a very strong base of 18% growth last year similar quarter. It was partly aided by the pantry loading in households in the early stages of the outbreak, which accelerated the already strong performance in Jan-Feb. Given the increased awareness towards health, Saffola seems to find itself in a sweet spot. Resurgence of in-home cooking will lead to a trend of eating healthy and higher consumption of healthy and trusted brands. Saffola is well placed to ride this wave of health awareness and should continue to consolidate its position on the health platform. Backed by media investments, effective brand communication and shifts in consumer behavior, especially among top-end loyal consumer households, whose in-home cooking occasions have nearly doubled, we are extremely confident of driving double-digit growth for Saffola in the near term. In food, the oats franchise has a very good quarter with a 23% value growth. We will drive innovations to new flavors in masala oats to suit the various regional palates and continue to build the brand relevance with health at its core. We also see opportunity for Fitify and Cocosol in the respective niches and will continue to innovate in packaged foods to serve healthy in-home consumption needs of our consumers in the post-COVID world. Our discretionary personal care portfolio of serums, male grooming and skincare are understandably not favored and consumers prioritize essential items of daily use in the days leading to the lockdown. These categories have been under stress since they are relatively non-essential, are trending at a low run rate even in April. We are mulling over a low-value, small-pack strategy to allow consumers to access some of these offerings in a slow economic environment, in addition to focusing on e-com and chemist outlets to drive consumption at the top end. Therefore, we'll reduce our investments in these categories and channelize our energies towards aggressive share gain in our core categories, along with focus on health, hygiene, and nutrition, which consumers are strongly gravitating towards in the current context and will continue to do so in a post-COVID world. We have launched Marico hand sanitizers and Veggie Clean in April, and we're looking to broadening our play and build a sustainability portfolio in the near future. A similar initiative in health and hygiene is also being driven in Bangladesh and some of the other key markets. Coming to international business, Bangladesh was able to post growth since it was impacted only once the lockdown in the country was imposed in the last 4-5 days in March. The business continued to perform healthily, led by the non-coconut oil portfolio. Vietnam also ended in the green as the country had limited restrictions during the quarter. We have launched hand sanitizers in both markets to help consumers fight against the pandemic. Both MENA and South Africa had a tough quarter given the already struggling macros and severe impact in primary due to COVID-led restrictions. I must add that the secondary decline in the Middle East is actually mid-single digits as compared to the huge primary decline because we couldn't export and transfer the stock in primary terms towards the last few days. We are optimistic of a recovery on ground in Bangladesh, Vietnam and the Middle East over the course of FY21 as per initial trends, which should enable the international business to stay on the growth path from Q2 onwards. Now let us give you a flavor on how consumer behavior and demand patterns may be shaped by this unprecedented crisis. I will cover some of the key shifts in consumer behavior which we have been agile enough to effectively respond to. The rising consciousness towards health, hygiene and the need to boost immunity, high incidence of in-home cooking or gravitation towards healthy, ready-to-cook and ready-to-eat, cut back on discretionary categories during a rather prolonged macro slowdown. Consumers are likely to be more value-seeking but will still prefer trusted leader brands. Further acceleration in online shopping and online media consumption and the recovery and the growth of the kirana. Therefore, we need to focus on 5 things to come out unscathed from this crisis and actually turn it into an opportunity. Firstly, We realign our portfolio to capitalize on changing consumer trends and preferences with launch of products catering to the needs of nutrition, hygiene, and well-being in the current environment. Secondly, the severe disruption in supply chain has given rise to a number of alternative last-mile logistical options and new operating models. We have been proactively prototyping these in addition to introducing direct-to-home delivery portal for edible oil and foods in select cities and partnering with food aggregators to ensure uninterrupted supplies of food and grocery items of daily use to our customers across all channels. We will continue to test these various emerging delivery models to ensure where we can hit the ground running to those which prove to be sustainable for scale-up. Thirdly, we'll be selective on A&P while we reallocate spends from non-media to media channels in the near term to drive share of voice in the core. Spends on the digital platform will continue to rise to further boost our e-commerce business, which currently contributes to more than 5% of our sales already. Fourth, we are being aggressive on managing costs across the organization, where we are challenging every cost element and applying a zero-based lens to each expense head. And last but not the least, transforming the workplace and being future ready is key. We are already exploring aggressive work from home and automation programs, which complement the new millennial way of working. With some of the restrictions in the areas that are not identified hotspots and away from city centers, the availability of manpower and supply chain operations has improved over the last few weeks. Production has resumed in all our manufacturing units, although at a reduced scale. We are focusing on movement of all food and grocery items of daily use to the consumers, subject to necessary approvals from local government authorities. We are back to recording 70 to 80% of our normal monthly run rate of FY20. However, in the near term, demand and market growth is expected to be volatile, and it is difficult to have a view for the coming year just yet until more clarity emerges in rest of Q1 and Q2. With tight cost management, the company will strive to maintain the operating margin in FY21 at FY20 levels, which is currently around 20%. Before I conclude, let me say that we have had two relatively uninspiring quarters between Q2 and Q3. We were on a turnaround trend before COVID hit us, and our great agility and execution focus within Team Marico has only accelerated during the last few weeks. Therefore, I strongly believe that our coping ability has increased tremendously, which will help us in navigating through this crisis. Thank you for your patient listening, and I'm happy to take questions and stay safe.
Sure, thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Avnish Roy from Edelweiss. Please go ahead.
Yeah, hi Saugata. Congrats on a good comeback in the Saffola portfolio. So that is my first question. In the first 2 months, how was the growth? How much of that growth is because competitive intensity from Imami, which is struggling as a group in the unlisted entity, and some of the other players, it has come down? Because in the first 2 months, my sense is not too much of panic buying happened because awareness, etc., might have been low. So could you comment on that bit?
If you look at it, Saffola growth trend had already started in quarter 3. In fact, Saffola, if you look at even the full year, last year also, Saffola growth rate was overall 8%. We had a relatively modest or a very, very low quarter 1 and quarter 2. We grew 11% in quarter 3. And even if that COVID or this one had not happened, we would have delivered a double-digit growth in Saffola in quarter 4 also.
And edible oil raw material is inflationary, and you have become much tighter and more attractive to customer in terms of value. So how is the margin here versus say what it was 1 year back in this part of portfolio?
So I think as I said, that and I would have mentioned it even last year, that what we are doing is we are ensured, and we have done this exercise in Saffola, 2 things. What is, we channelize all our spends into giving consumer value, therefore taking out money from, say, some of the TOs and COs we used to do and give it to the consumers on a value, and also the fact that we also promote, if you notice, gold and total more than the entry point packs, because in the last, one of the things we realized that when you used to promote active, it is to lead to a reduction in this one. So our focus is actually to ensure we promote gold and total, which has higher realization. So I don't think there is anything to be concerned about in Saffola, obviously, margins. Having said that, for every company in this last 1 month, obviously supply chain costs would have gone up a bit, but then obviously it is made up by the reduction in A&P and other spends.
My second question is on the distribution. So this telecaller facility with 80,000 top retailers, have you done that before, and how is the cost structure and response? Similarly, on the porter delivery and direct to home delivery portal, these are really good innovation you have done, and some of the other companies have done. How much is it working in terms of response? And if you could discuss a bit on the cost structure.
See, our immediate endeavor is to ensure that consumers get availability, because at the end of the day, consumers are searching for trusted brands. Consumers are doing some kind of a loading, and if you don't make availability, and we realize that is the most important thing. So we are experimenting with different models. There is a telecaller model, could be an app model, there could be 2-3 with retail aggregators, and even we have started our in-store, which is a brand.com, Saffola in stores.in. So if you don't get your Saffola, please order through it. So I think we will, right now we are ensuring ensuring availability. Give us 3 to 4 months, I think we should be able to give, which are the, out of these, maybe we are trying 9 experiments or 10 experiments, 4 will deliver value or 4 or 5 will deliver value. I think these are the ones we will scale up, and then the other ones will slowly withdraw. But I think it's too early right now. I think our entire focus is to make the product available, because for me, availability is going to lead to market share and sales at this point in time.
And last question on VAHO and hair oil, work from home, there is much lesser need in terms of grooming, etc. A lot of Indians use hair oil for grooming, looking better also. So do you see that as something which would have impacted in April and the last 10 days, not looking into the supply side? And is that a risk? Because then it becomes a habit, right? You don't completely shy away from hair oil, but you reduce the consumption.
See, I think if you look at what are the occasions, if you don't go out, maybe you will wash your clothes less, you will wash your hair less, and you will use non-sticky hair oil less. Now, the core hair oiling, which is pre-wash, I don't think it gets impacted. I would think the premium non-sticky hair oil portion, which our participation is slightly lower, that is where we have done some consumer checks. That is what the indication is, that a lot of male consumers use non-sticky hair oils for hair setting and grooming when they go out. That occasion would be less. But I don't think work from home is going to, while it will be a perpetuity, the large mass of Indian population someday has to go out and work. This work from home could be maybe for the top 2 or 3% of the population or 4% of the population. I don't think it is for that. So I don't think the core hair oiling as a habit is not going to sink. But at the top end, I see some change, especially non-sticking hair oils, which are priced at a much premium. The non-sticky hair oils, which RPI are 1.1, 1.2, is not likely to get impacted, but there could be certain brands which are priced slightly premium non-sticky hair oils, they can get more impacted.
Okay, thanks. That's all from me.
Thank you. The next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity. In your outlook, you mentioned that you're looking to enhance the value proposition of recruitment packs in coconut oil. Can you provide some more insights? Are you looking at price cuts, or is it driven by your outlook of lower raw material prices? Yeah, along the same line, your views on copra price. I read somewhere that it slumped meaningfully in the current lockdown. So yeah, that's it for me.
Yeah. So let me just give you obviously in the last quarter I had indicated that the price could be slightly inflationary. I think it will be slightly deflationary, and it could even further go down. People are not going to temples offering coconut. A lot of coconut chutney and everything is used, as you know, in a lot of restaurants which eat out. So a lot of coconut demand has gone down. Obviously, there are supply constraints in the sense that because of logistics and all, I believe it will be mildly deflationary right now. And we now know we have just done a market mix modeling and category growth driver exercise where which are the recruitment packs, and therefore we will ensure that we will price. This is a great opportunity to take market share and ensure that people don't either downgrade or have the attractiveness to upgrade, even with the pricing. You must realize Parachute is one of the very few brands which are, manufactured very hygienically. People want to use brands which are trusted, untouched by hand, and therefore this is a great opportunity. And of course, to grab share in terms of distribution and in terms of the fact that there could be competitors with working capital constraints, unable to procure or unable to actually distribute. So we compete with a lot of smaller players, and therefore we will be aggressively pricing. And fortunately for us, I think earlier, as I said, the indication of the fact that there would be slightly mild inflationary, that is not the case as trends are now.
Sure. Just one more question. In Bangladesh, non-coconut portfolio is growing at a very impressive 25% plus. What is driving this kind of growth, and how sustainable is this? And how is the impact of COVID in Bangladesh? That's about it.
So Bangladesh is going to likely to open up while the situation, I think, is slightly better than India. They want to use the Indonesian model, as you know, which is basically they want to balance the issue of trying to get the economy rolling, and this one, and given a very young population, they believe that they need to balance both. So Bangladesh is most likely to open up. The lockdown was less stringent. The thing is, not only value-added hair oil has grown, some of the new products category, skincare is doing well. Foray into baby is doing well. You must realize that in terms of sheer strength as an FMCG player, especially in personal care, we will be number 2 to the main giant leader there in Bangladesh. Our relative position is far more stronger. And therefore, we intend to continue to leverage our distribution brand equity to grow. And I think given the fact that our experience in diversification, and also I think some of the learnings which are there in India on NPD, we have been able to use this in Bangladesh, and given the fact that our strength is higher, we will continue to do the journey. We started 2 years ago where non-parachute was 10, it is now almost hitting 30. And hopefully in another 2 years, the non-parachute component will become 40%. So we have entered baby category, and we will enter into 1 or 2 more categories in the next 1 or 2 years.
Okay, and that's it from my side. Thank you.
Having said that, just one word of caution, I think, in Bangladesh is that obviously one of the biggest growth drivers in Bangladesh is the RNG business, and they will depend on the Europe and the US recovery. So therefore, the high growth rate that was witnessed in Bangladesh GDP might not happen this year. But having said that, given our competitive position, if the category growths are a little lower, we can gain market share. And number 2, also continue to operate into diversification criteria. But the Bangladesh economic growth is likely to be lower than what it was last year, the boom that was witnessed.
Understood. Thank you.
Thank you. The next question is from the line of Percy Panthaki from IIFL. Please go ahead.
Hi, good evening, sir. My question is on the hair oil category in general. See, hair oils, we have about 4 or 5 listed companies having some business of hair oil or the other. So we have a very good understanding of what the growth trends are in this category. And over the last few quarters, we have noticed keep COVID aside, last few quarters, hair oil growth has been slightly weaker than the general FMCG growth. General FMCG growth itself has been weakening continuously over the last 4-5 years, except for the spike during GST, etc. So just wanted to understand the overall view you have on hair oiling for the next 12 to 24 months. Already weak category, seeing further weakness on the back of COVID, not because of supply chain disruptions or something, but because of a slightly longer lasting income or wealth impact that the consumers will see, which of course will affect all other FMCG categories, but also hair oils, which is not seen as such a essential category when consumers are cutting down their spend. So some thoughts on that, please.
So if you look at, I think, again, Percy, I'm happy to share the Nielsen growth. Hair oil, VAHO has not behaved so differently from shampoo, soaps and skincare in the last 3 quarters. So all the personal care, especially in rural, has got impacted. And I think in the case of VAHO, what has happened is there has been a bit of a the market has moved towards slightly at the bottom end of the story. So I don't think in terms of penetration, if you look at the household data, there is any significant change. What has exactly happened is that the market, as I said, has moved from the slightly premium. So there are two drivers of growth. One is, of course, the top end, which is being driven by modern trade e-commerce, the problem solution and the good sensorials, and at the bottom end, which is there. So I think if you look at, I don't see any difference. It is, you must also realize that, in the sense that what happens is that hair oils also will get advantaged by the crude, the fall in crude and the packaging. It is a lot of crude. VAHO is linked to a lot of crude. So therefore, the ability of the players to pass on pricing and make the thing attractive so that consumers don't downgrade. I think that is the issue. And the second thing I think, and VAHO we must say it is unique, is that a lot of people might have the option of moving into smaller brands and downtrade, unlike other categories where the category is concentrated in 2-3 brands. It is little fragmented, there is a long tail, and therefore if the value proposition is not right, there could be a situation where people can downtrade. So we will ensure both of them not happening, but what I want to assure you is that there is no reason to believe, if you look at penetration, usage, and also the fact that the category has not behaved, VAHO has not behaved any differently from some of the other large personal care categories in the last 2 or 3 quarters.
Understood. So when I was mentioning hair oils, I was also in my mind considering the coconut oil also, because the main usage is for hair. And there also, as you mentioned for VAHO, there also is a option for consumers to go into smaller brands or even go into loose, as downtrading overall is probably expected to be a trend in FMCG, at least for some customers now. And we don't, unlike VAHO, where we have a price laddering, we have premium brands, we have economy brands. In Parachute, we really don't have that kind of laddering. So how do you plan to sort of protect your franchise in that segment?
So I think I mentioned it in this one. I would not like to get into details of it, in the sense that our endeavor is to ensure that for all the segments we participated in this year, we will try to ensure we cut all possible costs in the system and pass value to the consumer, so that consumer gets value. We agree that the disposable income of the consumers will be challenged, and therefore it is our endeavor to ensure that we have to, even if some of the category growths in all the categories we participate across our company, across the entire portfolio, if some of the category growths has become lower, we will ensure that we continue to gain higher market share by driving pricing. And the second thing is that also continue to drive aggressively rural distribution, because I believe 2 things are going to happen. One is the wholesale channel will be further challenged because of the fact that there will be people not wanting to travel to urban areas to buy, retailers coming because of whatever COVID and other fear, and travel will get restricted. So therefore, companies with direct rural distribution is likely to gain. Number 2, I think as I said, the return of the kiranas. So therefore, companies with direct distribution in urban are going to gain. So I think it is, at the end of the day, our job is to ensure that we provide value, we continue to make it accessible and start gaining share even if category growths are lower.
Understood. Second question, sir, on costs. Apart from advertising costs, which I'm sure most companies would look at scaling down, can you give some more details on what kind of cost restructuring you are looking at?
I can't get into details. All I can say is that, when you are constrained, people, when there are things are going okay, we of course are a company which is cost conscious. Even now cost structures compared to others, are relatively smaller. Having said that, I think what happens is whenever there are constraints, you get with the best ideas. So we are doing a zero-based, costing project, and it is just, we are doing anything which are nice to do, we are cutting, and we are looking at it very, very aggressively. I don't think advertising costs are going to reduce more than maybe 100 basis points, and that is because with 100 basis points, we can also maintain share of voice, and also I believe given other categories are likely to, other sectors going to advertise much lesser, our CPRPs and impact will be similar even if I reduce it. So I see a A&P reduction of maybe 100 basis points, but we are looking at all costs, and I think the exercise has begun. We are seeing early gains even in Q1 as we speak, and I think it's an organization-wide program which we are looking at, including including ideas and looking at even the way we can save costs. Having said that, our first duty to ensure is that we protect jobs, and that is something which is important for us. But there are a lot of other costs which we can look at.
Right, sir. Thanks and all the best.
Thank you. The next question is from the line of Deep Maheshwari from Jefferies. Please go ahead.
Hi, good evening, Saugata. Hi, good evening, Vivek. My first question is on the current utilization rate when you mentioned 70 to 80%, and you also mentioned that fourth quarter had a channel destocking. So this 70 to 80% factors in that, or is there some bit of restocking which is also taking place, which means the real manufacturing number on a sustainable basis will be lower than what you called out just now?
I don't think we have been able to do any restocking, to be fair. And the reason is very simple. If you look at it, I would say the Saffola STRs will be half day almost. I mean that is the kind of this one. I think what has happened is, I believe still now there will be in the rural part. I would say that we have, in a lot of cases, I don't think we have been able to reach. In a lot of states, as you may be knowing, there are very, very stringent rules during lockdown which reduce the supply chain availability. So to give you a perspective, if you look at, there is a primary secondary gap which was there in March. Have we been able to do more primaries than secondary? The answer is no. In fact, I would think, as I said, from the Saffola and food part of the portfolio, and similarly some of the high velocity parachute packs, I think the STRs would have gone down also in April. So I don't think that restocking will be issue, and I believe we have seen this in GST, we have seen this in demand. Some of the stock reduction that happens, especially in wholesale channel and all, are sometimes permanent. You only recoup half of it. So I believe that the distributor stocks have gone down, and even now in April end is far lower than what the distributor stock was maybe in February or January. And the retail stocks, especially some of the retail outlets have not even opened. And I am very clear that in rural and wholesale, the stocks have gone down.
Got it. And in April, the trend that we saw in March, let's say, for the fourth quarter, pretty much are those. How is the category mix? Basically, is it stacking up in the same way that it was in the fourth quarter? I know typically you don't comment about fourth quarter numbers, but any sense on April in terms of Parachute and Wahoo will be very helpful.
I would not like to.
Given that these are excessive
details, but all I can tell you is that other than the discretionary part of the portfolio, and as I talked about, I think the core part of the portfolio is trending more or less okay. Obviously, Saffola is far higher, but there is no concern on the core part of the portfolio. There is no concern on, some kind of, habit change, as I said, we are seeing anywhere.
Okay, got it. And since you mentioned about consumers, so second question, since you mentioned about consumers will be more value seeking and the foods is rightly placed over there, how do you think about the foods business, and does that change, this crisis change your launch activity in the foods? Let's say you spoke about 55, but if consumers are more, let's say, value seeking, is there a case to go more mainstream? I know margins are an issue in foods generally, but how are you thinking about this, given in the context of crisis, and any sense on or any thoughts on going mainstream rather than just catering to the top end of the market?
So there are two kinds of polarity that is going to happen as far as the consumer is concerned. At the top end, and which will be primarily driven by e-commerce, there will be a huge focus on buying something on health and well-being and immunity. And mind you, there will be shift of spends because the top end consumer is not going to travel to Europe twice a year, is not going to go eating out or going for entertainment. There's enough disposable income available to get into the best quality nutrition, well-being, and e-commerce is making that product available. So at the top end, I think Fitify and Cocosol, as you know, Coco Sol virgin coconut oil has very strong immunity properties, as we have heard from various readings in international literature. So they have immunity properties. So I think that will continue. As regards the mass, you are absolutely right. I think as the in-home usage occasions or consumption occasions will increase, which could be ready to cook or ready to eat, people will also look at healthy and trusted brands for it, because the number of occasions will increase, and therefore if there are opportunities in scale in food, we will do that. And the way we look at food margin is always, as long as it's better than Saffola edible oil, it's accretive in our food business.
Okay, got it. And my last question is on A&P, 24% decline in India or at the standalone level. I mean, is this just due to the due to the lockdowns from whatever you did in those 7-8 days? Because this 24% drop looks too much, given that it was a sudden lockdown and you would have had contracts with the agencies, and also can you elaborate on the 24% decline, please?
So I alluded to it during my opening remarks that last year in the base we had launched, we had done the prototype of Kaya, we had done True Roots, we had done Creme Oil. So a significant portion of the reduction in spend was actually on the NPDs which are not there. There was no NPDs this year, this quarter. Okay. Secondly, if you look at, you are absolutely right. By the time the lockdown accelerated and we started getting a feeling at it post the Holi break, which was 10th and 11th, in any case, you can't really, so only perhaps towards the very end, fag end of the quarter, whatever could cancel, got cancelled. So most of the reductions are in the base. So the core, there are hardly any decrease as far as core is concerned in terms of the spend, and both in international and in India.
Okay. And just a follow-up to A&P, when you say 100 basis point at best decline in F21, that's on a full year basis.
Yeah. That is on a full year basis, and I believe the first run, the modeling which we have done is that even at 100, 120 basis points, you can actually maintain SOVs and CPRP. You will get a reduced CPRP, and in fact there will be no problem. I'll give you some examples. A lot of money is spent on promoters in modern trade. Where will be the promoters there today? Anything which is social distancing, a lot of spend. Can you shoot a film? The earliest film shoot will happen, I guess, 6 months later now. Who is going to do a film shoot today? So there are a lot of costs which will anyway go down. Yeah? I mean, physical consumer research will go down. We have moved to digital research. So there are a lot of marketing spends which are automatically not going to happen. So I mean, there's getting out 100 basis points will not lead to any share of voice. In fact, I can still manage some share of voice increase.
No, sorry. My question was exactly opposite. I thought that 100 basis points should be the minimum, because I mean, while you're talking about SOV, but I'm guessing that given the context that we are in, the savings could be far higher than what you are.
Again, it's very early to say, but in fact, I alluded to participation in foods and health and hygiene. If there are opportunities, why shouldn't I invest?
Right, but at the same time, VAHO will go down quite a bit, right? If the consumption is that much lesser, then the savings will also be that much higher, right?
VAHO, I think it's too early. I mean, again, if you look at the pyramid, as I think, let me just address this again in VAHO. The core of VAHO is not going to go down drastically at all, okay? That's the non-sticky part of it. And if you look at the non-sticky and the premium part of the business, we have a disproportionately lower share. So our initial trend suggests you get trends, okay? The broad trends according to us suggest that anything which is 1.3 to 1.6, the impact, and especially if it is non-sticky products, the impact is far higher, which are used primarily for post-wash.
Okay. So
if you are asking me, is Amla desperately impacted? The answer is no.
Okay, and just to conclude this point, basically, does that 100 basis point in a way signal, let's say you eyeing market share gain, and therefore that number is because I would have imagined that number being down by like 200-300 basis points on a full year basis.
Hey boss, it's like this. Listen, it's very early. It's very difficult now to say. I am not a I can't model it right now. I just gave you a number. Our initial trends indicate now Q1 the drop could be higher. I am assuming things will be partly normal, and therefore I am putting a number. Now it could be 150, 200. My initial going in position, it could be 100 to 150. It's very difficult to say at this moment, but there are three things we are going to definitely do. Continue to provide value to the consumer. I would rather go for fixed overheads than getting on A&P, and I will spend less money, far more on non-media than media. And our objective is, even if category growths go down, can I maintain my volume growth by gaining market share?
Perfect. Thank you very much, sir.
Thank you. Before we take the next question, we'd like to inform participants that in order that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. We take the next question from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good evening, and thanks for the opportunity. So both my questions are on Saffola. Firstly, did you see a disproportionately higher sales for your larger SKUs for Saffola? When you talk about the preloading in particular, was this one of the trends that you saw?
Yeah, you're absolutely right. I think this is the time to actually make ensure that the existing loyal households continue to get Saffola and consume Saffola. I can tell you from my own experience, the number of, as I said, the consumption in terms of eating at home has actually more than doubled, and therefore the existing households consumption is likely to get doubled. Obviously, we have capacity constraints which we are trying to unlock, and therefore it makes much more sense to drive growth in the large pack. This is not the time to drive penetration of small packs in Saffola, but to ensure that your existing loyal households who are consuming much more get their Saffola, and therefore the growth, and it also helps in productivity in the plant. As you know that at the end of the day we are operating maybe with 30% people because of social distancing, other things, to produce 5 liters as opposed to 1 liter, the productivity drastically improves.
No, fair enough. Completely makes sense. But is there a risk because of this that then the demand is a little bit lower, given that there's probably been a little bit of pre-selling demand going into Q2, say?
I think, that pantry loading happened in March, and I now think it's a kind of a rotation sale that's happening. So I don't think right now you see panic buying of the pantry loading that happened. That pantry loading happened more in the 2nd and the 3rd week of March. Right now we are not seeing that panic buying because at the end of the day, as I said, that people in a lot of red zones are not necessarily going out. They're obviously ordering the larger pack sizes because they don't want to increase the trips frequently. But we are not seeing significantly any pantry loading as such. As you know, we have e-com, you can take daily trends and analytics in terms of the people who are existing consumers. So that panic buying is over.
Thanks. And just last question here. In terms of the price of competitive edible oils, has there been any sort of sharp differences there between Saffola and any of your competitors? I mean, and not just the like-for-like oil, but even different types of edible oils in more or less your price point.
I think in December, January, there was a subtle inflation where I think there were some price hikes in some of our competitor brands that time. Right now, the outlook is that there will be, so the ballpark premium actually may have reduced a bit. But, I believe over the long term this year, given the supply-demand situation, it will be mildly bearish, the input costs. As of now, obviously, given the fact that there's a scampering for raw material and other things, there's slight bullishness marginal in the procurement and supply chain maybe. But in terms of relative terms, our premiums are reduced because we haven't changed our pricing and we have kept a uniform pricing for the last 1 year actually.
Fair enough. And this will be largely rice bran oil, right, which is competition?
That could be anything. People upgrade from sunflower, people upgrade from different other species.
Fair enough. Thank you very much.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Good evening, Swagata. Thanks for the opportunity. Swagata, you called out that the missing rural growth has been the problem area for personal care category for quite some time. Now, if you see last year on most rural macro tracker points in terms of rainfall, increased MSP, direct benefit transfer like PM Kisan and all, they all suggested that rural has to perform better. Now, in spite of that, the deceleration continues. So, in your prognosis, what is keeping rural consumers away from personal care category?
I think if you look at it, that the rural, the benefit of the whatever the government has done or the produce that happened, the good rainfall was supposed to start, that some recovery trends which we are noticing. In fact, if you ask me, our Jan-Feb trends were not that bad. Okay, so there was some improvement of it. So I believe that the overall disposable income has not significantly altered, and they were about all to alter when I think this COVID thing happened. Going forward, I would say that it will be stressed, although I must say that, compared to, I believe that the unemployment or lowering of activity will be more happening in urban than rural in terms of, economic activity and therefore disposable income. The issue in rural will be slightly different. According to me, if you look at the rural, the wholesale as a channel will become difficult, the entire supply chain mechanics of it, and therefore direct rural distribution and value will be the two drivers of growth in rural. Having said that, obviously we have to be very, very watchful. We don't know exactly what has been going to be the impact in terms of consumption going forward, but whatever indications are, according to me, and whatever crop and whatever information we have, I would think the bottom of pyramid growth in the urban poor will be much more impacted, because if you look at migrant labor, they have returned. I don't know how many will come back to urban, and actually consumption might grow in rural. So I would be more concerned about urban bottom of pyramid than rural in the immediate couple of quarters.
Great. Second question is, in last 40 days, we have seen a lot of disruption in terms of supply chain, distribution, and even the consumption pattern. And then Indian businesses, like always, have used all the jugaad possible, if I may call it, to service the consumer. So out of all the changes that we have noticed in the last 40 days, which you believe will stay with us for slightly longer period even after normalcy comes back, and which are much more transient, like Kirana gaining market share? Is it a structural change you think this will redefine the Kirana's game in the market share in the game, or these are all transient and there are very few structural changes which will emerge out of this?
I think there are clear 3 structural changes I see happening. One is Kirana plus e-com, the fact that I see Kiranas coming back in terms of, people going to because at the end of the day, a quick shopping trip with social distancing, I think that is an important thing. The second is e-com, and therefore I see a lot of modern trade players moving to doing both online and brick and mortar. And I think this will happen. The third thing, there could be significant changes in urban GT, the fulfillment as well as the order taking. I think we have, seen a lot of changes and a lot of experiments that are happening. The traditional order taking, which is a distributor order taking followed by a delivery man of a distributor fulfilling it. Today there are multiple models. In fact, there are certain cases, it can go to from a CNFA directly to, a certain, the way the modern trade is serviced. So tomorrow there could be multiple ways of fulfillment. And I think there will be structural changes in that. The last change I'm seeing, which is noticing, if you look at a lot of, these beauty outlets and premium personal care. Now the premium personal care, there is still a pent-up demand, okay? And, while the occasions, people moving out has gone down, but still there is some demand, whether it's some of the premium. We see a transfer of that demand, and that could be transient, not necessarily permanent, from beauty outlets which are currently not open to chemists. Anyway, the chemist guy is open. The chemist guy is servicing you. He's doing a home delivery of the medicine. He's also doing the premium personal care there. So that is one more trend which we are noticing. So therefore, a lot of brands which are unable to sell through, say, which were selling through cosmetic wholesale or beauty outlets are actually selling through chemists today. And maybe the last structural change that will happen is some of the salon brands, which are sold today, people will take time to be comfortable visiting salons. As you can see, a lot of DIY personal care, salon brands at home.
Thanks a lot, Saugata, and all the best.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Hi, good evening. So two questions from my end. So just wanted to a little better understand the situation over the last 35 odd days. So within your entire India portfolio, you would be now running at about 75 to 80% capacity utilization. Is that correct, you said?
Yeah.
And in terms of touch points, you have 5 million, kind of touch points. From that standpoint, how much progress do you think you have made in the last 40 odd days? I mean, would that also be 75, 80% or would it be probably a little lower?
I think it will be lower. Again, as I said, that it depends also on the situation where, the number of distributors and outlets on the red zone. A lot of, in a lot of cases, people are coming to a distributor point to pick up, or we are using some other alternate delivery point because the distributor is not ready. So in terms of, if you want to ask me the capacity of distribution, obviously it is getting channeled maybe a little bit through high throughput outlets.
Okay, got it. And safe to assume now that technically you are allowed to make and sell everything, but you would take your pick depending on, how the market is responding.
Yeah, obviously. I think the issue is that wherever, I think ultimately it depends on the local government authorities at the end of the day. Whatever they permit, we strictly follow that. And number two is, for us, what is most important is people's safety and in the factory. And obviously, as you know, that if you operate the strict measures, including, people staying within the factory premises, maintaining social distancing, the capacity of the factories today, they are working at a lower rate, obviously. And which means that there's low stock in the channel, low stock in the depots, low stock in the factory. But we are ensuring that, we maximize on it. And therefore, I believe that the entire, the stocks in the pipeline right through the system has thinned completely.
Got it. My last question is on the foods portfolio. So for F20, could you give us a number of how large the portfolio is now in terms of size?
Around 200.
So you ended at close to 200 for the year?
Yeah.
Okay, that's it for me. I'll come back for more. Thanks.
Thank you. The next question is from the line of Aman Rati from Morgan Stanley. Please go ahead.
Good evening, sir. I have two questions. The first one is basically based on the COVID situation, how do you see the next year business plan and what are the growth estimates you have? Maybe if you could walk me through the quarter-on-quarter basis. And second, what all issues have you actually faced with respect to the logistic parts in delivering the products or in receiving the raw materials, etc.?
So I think it's very difficult to, as I said, to give you a view on quarter, and I'm not going to give you a guidance. I think all I can say is that we are 70 to 80% of our annual run rate. Our objective, and we hope things will normalize. Our objective will be to ensure that we maximize availability. We gain market share in places where even the category goods go down a bit. We provide value to the consumer and participate in new categories in health and hygiene and maybe a little grow more in food. So I don't think we can give you a number right now, a guidance. And of course, I said that we will maintain our EBITDA percentages and have a high cost this one. So all these contours are right. We don't, it will be more, I think, fair to give a number, look at an outlook, let things pan out over the next 2-3 months. I think the next 2 months are extremely crucial as India eases its lockdown. And also we have had situation where Bangladesh and some of the international markets have eased the lockdown. So we'll see how it pans out, and maybe we'll be in a better position in end July when we have the next call in terms of the next quarter to give a broader outlook. Your next question on the supply chain, can you just repeat the question, please?
Okay. Yeah. So what all issues have you faced with respect to the logistics part, both in terms of supplying the finished goods as well as the receiving the raw material, given that are you facing any driver availability issues or lockdown measures, restrictions, etc.?
Yeah. So I think it started off, obviously, there was a truck availability issue, interstate transfers, availability of labor and CNFA or, labor to load the stuff. Things are progressively improving. I think with the fact that, the government, the ministry, Home Ministry coming with different advisories, notifications in most of the states, there is either the central or the state e-passes which are there. Things are improving, but I think where we are very comfortable as far as all the RMPM is concerned for this quarter, more or less. We don't also have too much imported material. We don't use too much of imported where supply chains would have got disrupted. I think we also, as you know, most of our suppliers and the vendors are reasonably medium to large size suppliers, and they have also started, what I say, they have started at least by April 10th, a lot of them had started, and some of them started after April 21st. So we are okay as far as RM and PM is concerned. The only issue, as I said, is that as far as Saffola is concerned, obviously we are almost selling day to day.
Okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Qtr4 from Buena Vista. Please go ahead.
Yeah, thank you for the opportunity. Two quick questions. Firstly, apart from normalizing inventory at the distributor level, are you providing any other form of support to them to optimize their ROI at this point?
I think our obvious objective is to ensure that we will support them. There is selective credit extension. Also, what we have done is we have ensured that we, for all the distributor, sales force, and all the third party, we have given them COVID insurance. We gave them a 1 month, some kind of a support, in terms of cash payout to all the, these people who are in the third party, as in the distributor sales force. And we are also ensuring we invest and train them on all the entire health, hygiene, and sanitation practices. And we are going to ensure that we continue to support them as we move. And I think also we have given them a lot of support in terms of delivery to the final since they couldn't manage to open their delivery points. In a lot of cases, we have helped them in supporting through third party delivery systems.
So most of these seem transient. So once the COVID impact wanes and we start to get into some sort of normalcy in 2Q, can we say that by and large it will be back to the original term?
Well, I think during these, as I said, there are certain cost efficient models we have, looked at, and some of the efficiencies which could have scale, which you could have automation and other opportunities. So we will definitely work with our distribution partners to ensure that they are profitable, because as I said that one of the things we were grappling with last year was this urban GT ROIs. I am glad to say from Q3 when we started implementing the minimum operating price and different assortment across channels, those channel conflict issues went off. We took a hit in Q3 in terms of, as you know, in e-com and modern trade. So I think supporting our our distribution fraternity is topmost in our minds, and I believe this COVID post that some of the experiments which we are doing, once you scale some of them up, it will be actually efficient from both the points of view, from the distributor and from the company, and it could be a win-win.
Got it. My second question is on
lastly, I think whatever So, I mean, there has been a certain stock correction in the system. That itself, their investment would have gone down. And we might not want to, beyond the point, pump that also. I mean, we might say that, there's an efficient system we can operate with even lower stocks.
So basically that inventory level will become the new normal, right?
Again, it depends. I mean, at the end of the day, we have to balance inventory and also fill rates. So we have to see everything.
Okay, great. My second question is on VAHO. So we have a three-pronged strategy, but if we look in the mid segment and premium segment, where Marico is kind of underrepresented, do you worry that if the growth slowdown prolongs, the category growth itself may come under pressure, which means that the propensity to experiment is low, which makes it difficult for a challenger to gain share?
All I can give you a strategic premise that in case there is a challenger who can cause disruption, especially when disposable income is low, a challenger can certainly cause price disruption. But I see that there are two things which are going to happen. I don't see too much problem. I mean, in the problem-solving segment, people are buying it for efficacy, though they will continue to buy for efficacy. I think the vulnerable portion of the portfolio in the VAHO, we are least impacted simply because our presence in the premium non-sticky is far lower than some of the other players.
Okay, but you would still believe that the share gains in that segment will still be possible even if the category growth is under pressure?
That is because we are the share gain is happening mostly in modern trade and e-com, where our strength, I think amongst all the players in this segment, as you know, our modern trade and e-com component of business is very high, and therefore our strength in that these two segments are very high, very good, and our ability. So we will like to premiumize and participate in that category.
Got it. Thank you. Thank you very much, and wish you all the best.
Thank you. The next question is from the line of Prakash Kapadia from Anived Portfolio Management. Please go ahead.
Yeah, thanks. My questions have been answered. All the best.
Hello. Thank you. We'll move to the next question. The next question is from the line of P. Tendulkar from Rare Enterprises. Please go ahead.
Hello.
Yeah.
Yeah, thanks a lot. Sir, just two questions. How much of your own distribution, direct and indirect, you are able to reach right now after the 3rd May step down on the lockdown has happened? That is first. So that is the bottleneck, as you highlighted previously, that bottleneck is availability of the stock in the distribution system. That is one. And second is your Kitify, that is the food portfolio. How is the overall acceptance as compared to any brand journey, life cycle? In its like if you compare a successful brand and its life cycle, do you think that Kitify can turn out to be a big thing in next 5 to 10 years? Thanks a lot.
So I think in theory, 70 to 75% of the distributors are open. Now, at what capacity they are functioning, it could be slightly lower. And I think sometimes it is a function of their location, whether they are near a containment zone, and especially in some of the red zones. Rural also, I must say that beyond the top rural towns, the visibility in terms of our sale right now is slightly unclear because beyond stockist, how much actually vans are running, it is billing is still erratic. They might not be running the vans, and as I said that the last mile is still a little dark because they are not necessarily uploading everything on our system right now because in a lot of cases the salesmen are not coming. So I would say that's the broad this one, that in theory 70%, 75% of the distributors are open, and when I mean open, they're not necessarily open on all the working days, but sometimes the local authorities close down an area. So this is how it is operating, and maybe 50-60% capacity they could be working in terms of servicing the outlets. Okay. With regards to your second question, if Kitify has been only 1 year and has it been a grand success? No, but some of the things like green coffee and protein shake, I believe has potential. and we'll see how the brand stands now. And I think, as I said, that we have to be agile to the new consumer needs, and we will see how it pans out. I would say, if I had to rate the Fitify performance, I would say it is average plus in the first year.
Right. Sir, just last question. So in terms of distribution, what is the number for direct and indirect in your retail outreach?
We reach indirectly totally, I think, 5 million, around 5 million and 1 million direct. And we have been growing. In the last 1 year has been 5.3 million is the right number as of March exit. And I think we are giving a huge thrust on two areas, and we will improve that thrust as a direct rural distribution.
Correct.
And the second thing is urban, in which we have been growing in chemist, cosmetic and food. We have to relook at cosmetic, but certainly will continue on chemist and food.
Correct. So just one clarification. When many companies say that we reach directly into this retail outlets, it can mean various things for various companies operationally. So when you say that I reach 1 million outlets directly, that means that your company has all the data related to that guy, and your company
and third-party sales force of anybody, the data is there, and anybody, a third-party sales force, either of a distributor or a super stockist, is billing to that outlet.
Got it. Okay.
Secondary is happening from us. That is the definition.
Correct. Okay. Thanks a lot, sir.
Thank you. The next question is from the line of Krishnan Sambamurthy from Motilal Oswal. Please go ahead.
Yeah, hi. Given that you mentioned that there's been a selective credit being extended to the trade, and there's also been a relatively sharp increase in the proportion of modern trade to total sales, would you be satisfied with the fact that your receivable days increase was limited, and how do you see this metric going forward?
Can I ask Vivek to respond to this?
Sure. Hi, Krishnan. As you know, towards the end of March, we had to extend credit to some of our distributors, both in the urban as well as rural. But I guess once normalcy returns, we will be back to our own credit cycle of the past. Also, given the fact that the salience of last few days sales was more in favor of modern trade, that is another reason why you will see the distributor days going up towards the end of March. So barring a few chains, I think we receive our collections as planned from the modern trade. The CSD outstandings have also been on the rise, not just for us, for most of the FMCG companies. Hopefully, once normalcy returns and CSD gets its allocation from the center, we will get our money back. But having said that, it has a sovereign guarantee, so we don't have an issue on the credit quality.
Okay. How much has been the extension in case of CSD?
Sorry, can you repeat your question?
How much has been the delay from CSD?
I don't want to be very specific here, Krishna.
Okay. And on Saugata's point on modern trade possibly seeing a lower salience over the next few months as Kirana as well as online increase, e-commerce increase, do you therefore also see some moderation in the credit period as well, overall receivable days as well?
Very difficult to say exactly how it will pan out, but if e-commerce were to become larger, e-commerce receivable days are more or less in line with the modern trade receivable days.
Okay.
And just to clarify, I think what I said is that Kiranas which were declining might go up. Not necessarily, we don't have an idea of how it will interplay between channels. And as I said that brick and mortar modern trade also could do home deliveries and do online. The only channel which is definitely going to get impacted, according to me, is wholesale.
Okay. Thanks a lot, sir. Thanks for this.
Thank you. The next question is from the line of Amar Kalundekar from HDFC Mutual Fund. Please go ahead.
Yeah, hi, thanks. I just have one question. This pantry loading that you saw in Saffola, can you explain broadly what part of May did it start, and was it mainly in modern trade, was it in general trade? Around when did it actually start?
I would say towards 17th, 18th it could be. I mean, earliest, not before that. And I think there was the first, rumor of, and it's mostly concentrated. It will be in high throughput retail outlets and modern trade.
And your billing continued till what date?
Billing as in primary? Primary got impacted immediately after the lockdown. It was mostly some billing which could do to modern trade.
Okay, so bulk of this happened between, let's say, 16, 17 to 24th of March.
No, but modern trade had stocks, no? So to bill, to sell?
No, from your side, primary. I'm talking about primaries.
Yeah, so I will come in.
Out after 23rd. Modern trade, and there was whatever primary happened was mostly into modern trade. And but the buying was we billed modern trade, till before the cutoff, which is around 27, 28, 29. But we were billing only essential goods like Saffola and some of the other essential goods. But largely it was Saffola. But modern trade had stock to sell. Because immediately after the lockdown, first few days, I think very few other outlets were, they were sporadically open. And the distributors' points were also closed mostly.
Okay, the GT was practically sort of not happening from maybe 24th.
Often it's very difficult regular GT never happened. So now, if some distributor was open and somebody went there to get it, largely, I would say that GT distribution activity was almost shut in the last 7 days. These people going into the market that had stopped. Only towards the end, the passes happened and it started improving from April, the GT part of it, from 2nd, 3rd April.
Okay, yeah. Vivek, you were also saying something. I interrupted you.
No, I think Saugata answered. Thank you.
Okay. Okay. Thank you, sir.
Thank you. The next question is the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. Just two questions. Have we taken any pricing action in Jan, March quarter or April?
In Jan, March, we took some pricing action. Jan, Feb, we took some pricing action on Parachute, yes. Which was the last of the Parachute pricing action, and one pricing action on Jasmine. Some VAW pricing action. Very little, but largely the Parachute, because as I said in the last call, because of stocks of old Parachute, old price stocks lying in the system, so we was sometimes given as consumer offers, but effective pricing we took on Parachute.
Yeah. So what I wanted to understand, as you said that the discretionary part is going to have a disruption. So you alluded that you need to do some action in terms of packs. So do you think a PCNO would require some more price point correction, or would you think you will need to have a recruiter pack? Because you somehow, I hate saying that down trading. I'm saying the consumer skewness will be happening for value for money. So is that correct assessment?
If you look at quarter 4, there is a 4% already pricing built in, -8 and -12, the value growth.
I understand that.
So that will continue to flow through. And maybe, as I said, that pricing always need not come through, just basic this one. There could be a play between, consumer offer, trade offers into end pricing. Our endeavor is to ensure that we drive consumer value. And number 2, if as and when the things open up, there could be a situation where I can grab even retail share of shelf through actions. So, I think both through these two, my objective is, can I make my product available at an attractive this one? Because in in this segment, I can have a competitive advantage in terms of gaining market share, independent of the category. So what I don't want to do is, even if there is a category doesn't grow as expected, can I make up the volume growth through market share? And I would think that there has been a change in our outlook towards copra. I was saying mildly bullish in the last call. I would say now it will be mildly bearish.